Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is December 14th edition of Market Outlook. So, nice bit of a nasty sell-off this week in the markets. Let's see what's driving it and where we can end up. First of all, let's take a look at NASDAQ QQQ leading 100. Looking at the daily chart, you can see, number one, that the 50-day moving average well intact, and there is a substantial gap still unfilled that took place in the beginning of November or late October. So well intact, even with this sell-off, support really comes in around the 101, 102 level, and critical support is really at the gap and that rising 50-day moving average. But you can certainly see that the market slope on the 50 and the 200 well intact. Weekly charts can't even say that this is much more than a relatively, on a monthly chart, more than just a small intermonth correction. However, on a weekly basis, this chart that we had put in the lines, trend lines and channel lines quite a while ago, got to the very top of its channel. And so where we're finding support or looking for that support around where that gap came in on the daily charts, clearly the trend would still be intact all the way down into the mid-90s as well, which would mean a fairly more sizable sell-off. But at this point, support really around that 101, 102 level. Let's go back and take a look at the daily chart. Should offer really good support right in this area here, right around that, again, that 101 to 102 area. Now, going back to the SPYs, a little bit more pressure here in the broad market, and essentially what you're seeing here is an attack of the 50-day moving average, and it is rising, so that should hold. Critical support is really at the 200, which is around the 195 level. But nonetheless, this sell-off, although nasty, overall trend still well intact. Let's take a look at some of the market internals. VIX volatility. As you can see, we are still in a bull phase where the 50-day is over the 200 as a result of the October sell-off. So where we are extremely overbought, and actually if you go back and look at the weekly charts, you can see these spikes, these 1 to 2 week massive spikes, always seem to be met with a significant retracement, always moving back down to the lows. So interesting, we got this 1 week spike here. We certainly can get some follow through to the upside. Historically speaking, these particular spikes have retraced. Now, what is different this time is the fact that we are above that 50-day moving average, and this recent move up actually puts this VIX indicator here in bullish mode. So will history continue to play out as it has in the past, where these spikes in the market, in the volatility, massive spikes, right? We were down to, let's see here, almost 12, and now it's back up over 21. That's 60, 70, almost a 70% move. So that is significant. If you take a look at the tradable ETF on volatility, VXX, a little bit different story, or significantly different story. Again, you can see we're just trading at the 200-day moving average. We did spike above it, but different story here. VXX, which is that ETF on volatility, is still in, or was in, a bear phase until the last couple of trading days. So clearly a bit overbought, but that doesn't mean that can't continue. And if we can get a move above this 200-day moving average, you could see some significant follow through. We did peak in the mid 40s last October. So let's watch VIX, VXX, the tradable one, over the highs of Friday. That would be significant in conjunction with some of the shorter term trading action. In fact, let's go back to the spiders and take a look and see. Very, very critical level is really the 200 level, because that coincides with the low in early November, in fact the low of November, and the 50-day moving average as well. So opening range breakdown through that 50-day moving average, taking out that low, could indicate some more pressure, potentially another 1 to 2% on the downside. Now, one other thing I did want to mention is over the last several weeks, there have been 5 distribution days in the S&P. And despite the fact that we did make new highs on several occasions, we did that without any accumulation days. So that's very interesting to note. Furthermore, the deterioration in the breadth of the market, the new highs, new lows, continually getting a bit weaker as the market has moved up to new highs, is troublesome. Additionally, the number of stocks moving above the 200-day moving average as the market has made new highs has steadily declined on the new highs as well. So now let's take a look at bonds. Bonds are just roaring, massive breakout over the last week. Clearly, we are overbought by any stretch of the imagination. You can see the RSI here touching about 99. Our 50-day Bollinger Band about the highest it's been since the highs back in April of 2013. So with this weekly close into that reversal candle, if we can get a close above the highs that was set in mid-October, that would be an indication that this potential head and shoulders bottom is playing out, and that would give us another count and a very massive count to the upside, which could bring it up to 140 or 150 from a current price of 126.40. Let's look at some of the market internals. The McClellan oscillator clearly at a level where bottoms are put in. The shorter term, the 10-day advanced decline and up-down volume also reaching some pretty extreme levels, but we really need to see this thing curve around, and I would like to see the McClellan oscillator get above the even market, even level, which is basically a couple days away. But what we want to see is a return back over that lower green line, which is minus 100, and then back over neutral to confirm a buy signal, with the advanced decline moving above the red line here, which is minus 2,000, and the up-down volume ratio getting above the 0.4 level here as well. So clearly oversold, but that doesn't mean the market can't get more oversold. Remember, back September, October timeframe, The market was starting to sell off. We got hit pretty hard in the McClellan oscillator, and it was really only until the market recovered above the zero line, which is right here, did the market put in a full-fledged rally. So as we're moving down, we certainly can move lower, and we would look for the market to turn at least above that green line here, which is the minus 100, to start showing signs that its a potential bottom may have been put in place. Now, of course, the seasonals on the market is extremely positive. Second, third, last week of the year are some of the strongest weeks seasonally for the stock market. And again, the big question is oil, and will it continue to pressure the markets, cause potential deflationary fears, and get more of a reaction from Putin, which would look to increase unrest throughout the world and send some jitters, further jitters to the market. Taking a look at gold, you can see as the U.S. equities markets and equity markets sold off, gold sort of stabilized and moved higher on the week. This is exactly the type of action that we would expect as geopolitical fears increase and the market itself starts to, the equities market swoons as well. But again, this particular piece here, the gold piece, we want to see it hold just under the 50-day moving average, which comes in around the 114 level. That's pretty critical. And again, what is interesting is gold is starting to flatten out. This 50-day moving average is definitely flattened out. And by the way, this week we did confirm moving back into a recovery phase. So it'll be interesting to see how this gold market plays out and if in fact the potential long-term bottom has been put in. Another thing to note is this low here back in July of 2013, the lows that were put in at the end of 2014, and the failed bounce off of the October lows, we're now trading above that swing point. So from a psychological standpoint, we have certainly cleaned out any weak longs in the gold market. And in fact, this triple bottom that was taken out just in the last couple of weeks, we're now trading above it. So those who liquidated, if they're so inclined, are going to feel that if we start getting a little bit more stability, a potential move above the 200-day moving average, you could see a pretty sharp reversal in gold as well. And that would coincide, of course, with further pressure in the equities market. Well, that's it for now. Hope this was helpful. See you next week. Don't forget to sign up for this free video and the text report at www.marketgauge.com.